Now let's look at other types of long-term liabilities called long-term notes payable or installment notes. Now, these are similar to bonds in that these are a way for a company to borrow money where they're going to have an inflow of money, but they have a payment due and interest that they need to pay on this money. But these differ from bonds in that bonds are from a collective group of people who are all loaning money to the company. And an installment note or a note payable is usually issued from a single lender, such as a bank. So remember when we started talking about bonds, we said there was three ways for a company to get financing. One is to sell equity, one is to issue bonds straight to the people, and one was to get a loan from a bank. And that's exactly what this is. A bank will loan money to a company in exchange for this note payable, where that basically says you are going to owe all this money back and you're going to pay us some interest for giving you this money. So the example that the textbook gives us is assume Fog Hog, the company, borrows $60,000 from a bank to purchase equipment. The company signs an 8% installment note requiring 3 annual payments of principal plus interest. So in order to record that payable, we're going to debit cash because they're giving us $60,000 in cash, and we're going to turn around and purchase equipment. So debit cash for the $60,000, and we have a notes payable for $60,000. So now we need to calculate what are the payments going to be on that note. So it's going to be more than $20,000 because we're going to have the interest payment. $20,000 would be the $60,000 divided by 3 because there's 3 annual payments. But there's going to be an interest portion that we also need to be paying. So there is an Excel formula that we can use, and so I broke this, or I got this updated a little bit. So we will need the interest rate per period. We'll need the number of periods and the present value of the loan. How much is that loan? So according to this up here, the interest rate is going to be 8%. Number of periods is 3 because these are annual payments for 3 years, and the loan amount was $60,000. So the formula, we're going to do negative PMT. So PMT stands for payment. And you can see what the formula needs here. So it needs the rate. So we're going to select the interest rate, comma, number of periods. So we're going to select the 3, comma, and then PV, the present value of that loan. So the annual payments are going to be $23,282. So that is what our total payments are going to be each year. So if we look, we will, let's see, where's payment? There it is. So if we have a timeline here, so year 0, we borrowed the money for $60,000. And then we have year 1, year 2, year 3. So we're going to make payments for $23,282. Each year, $23,282. So that's what we're going to be paying to borrow this $60,000. So in total, if we do 282, we're going to pay a total of $69,846. That's what it's going to cost us to borrow $60,000. So, that's how much we're going to have to pay back to borrow $60,000. But what it's going to cost us is going to be the interest portion. So we know that the interest portion is going to be $9,846. Because $60,000 of that is going to be the principal balance. That's how much we borrowed. So we need to pay that back, and everything above and beyond that is going to be how much we pay in interest. So from an accounting perspective, how do we book this? how much do we book in each year? Because payments are due each year. So how much are we going to record as interest, and how much are we going to record as principal? Now, at first glance, you may want to say, oh, well, it's $20,000 of principal each year and $3,282 of interest each year. So in total, you're paying the $60,000 of interest or of principal here, and then $9,846 of total interest expense there. And so that may look good, but that's not how it's done, because the interest is calculated on the principal balance of the loan. So with each year, when we make a payment, a portion of that payment is going to go towards the principal balance of the loan. And so that 8% is going to be calculated on each year's principal. So the principal payment is going to change with each year. So if we go back to Excel, so we have our principal balance here of $60,000. We have our interest of $8,000. So this first year payment is going to be $4,800 of interest. So here we're going to say beginning principal, interest rate, interest expense, the principal portion, and the ending principal. So let's come over here. Let's also insert a line here and call this cash payment. So we know that our cash payment in year one, this is going to be year 1, year 2, year 3. So we know that our cash payment is going to be $23,282. We calculate our interest expense in this first year of $4,800. So the principal portion of that is just going to be the difference between our total cash paid and the interest expense on the loan. So if we take the total cash minus our calculated interest expense, this here is going to be our principal portion of the loan. So our ending principal on this loan is going to be beginning minus our current principal portion there. So you can see here that we have an ending balance on this loan of $41,518. Whereas if we were to record everything evenly, it would be a straight $40,000. But this is not how it works. We want to calculate how much of the payment is going to be interest with each payment. So then our beginning principal this year is going to be our ending last year. So if we take that, we're going to say this again is 8%. So our principal times our interest. Let's do this. Let's make that a comma, so that way it's nice and pretty. So again, our cash payment is going to be the same. So if we take our total payment minus our calculated interest, that's how much principal payment is going to be in the second year payment. So I'm going to take this formula and do it again. So this here is going to be our beginning principal minus the current principal portion of our payment. So then if we do this again, we have our beginning principal balance, 8%. So that times that, we're going to have the same payment. So this minus our principal portion. So you can see here that our principal portion equals our beginning principal, because at the end of 3 years, this loan is going to be paid off. So if I take this formula and do it one more time, we have a loan balance of 0. And that's what that Excel formula did over here. It calculated how much the principal payments are going to have to be in order to get this formula down to 0 at the end. So So you can see here that each year our interest expense is getting smaller and smaller because that interest is being accrued and being calculated off of the outstanding principal balance each year. So as our interest expense is going down, our cash payments are remaining the same. So the amount of principal that we're paying is going up. With each payment, the amount of principal is going up. So more of that payment is being applied to the original loan, and there's less interest expense with each year. Now, when it comes to calculating these principal portions, Excel will also do that. So if we go negative, and then it's PPMT for principal payment. So if we grab that formula, we have our rate. Then we have period, so which period is it? Then we have our number of periods, and then the present value, how much is the loan? So you can see here for number 1, we have the same amount of principal payment through Excel as we did doing it all manually. So again, negative PPMT, so our rate, which period are we looking at? How many total periods are there? And the loan, we get the same number. So Excel will also tell you how much of each payment is going to be applied to principal. Now it's important to know that this is an installment that is due annually. A lot of times banks want monthly payments. They want more regular payments, they want a payment more than once a year. So when we're looking at this formula, this is the rate per period. So if they wanted monthly payments, we would have to break this down. So it'd be 8% divided by 12. If we do 8 divided by 12, so 0.667%. So that would be, but then number of periods is also going to be plus 3 times 12 there. So our formula is going to change, but really why I say this is because you need to really be careful with this number or the rate per period and the number of periods. And so the text, let's see, the text goes down into a monthly period. So you can see here our payment dates are by month. So in this case, they changed the numbers a little bit, where they said a $60,000 note requires 36 annual payments, but they got this loan at 12% interest. So when we do this formula, we have a 1% rate per month, because it's the 12%. We're making 12 payments a year, and that percent is an annualized rate. So 12% annually is 1% per month. Number of months is 36, and we have a loan amount for the $60,000. So that amount stayed the same. And so we can do the same thing. We can run through the same formula, just $60,000 times 1%, because that's 1 divided by 12. Or I'm sorry, 12% divided by 12 is 1%. And so we could do the same thing, same formula for what the payments are going to be. We take our total cash payment, we subtract out our interest portion, and that gets us our principal portion of that payment. So then we take the beginning principal, we back out the current principal portion of the payment, and that gets us our ending balance for that loan, our ending principal, and that's going to be the next month's beginning that we're using to calculate how much of the payment is going to be interest and how much is going to be principal. Now, when it comes to payables like this, where there's an installment note, a lot of times an amortization schedule is run, and an amortization schedule lists out all the payments that are made, how much is going to be principal, how much is going to be interest. And so rather than calculate all this by hand, there are programs that will run this for you. So we have one here in the office, called T value. And so we just plug in those same numbers that we were using in Excel, and it calculates out how much the payments are going to be, or how much of each payment is going to be interest and principal. So here we'll say that there's a 12% interest rate. Then we have a loan that would have been on 12/31/2020 for $60,000. We have monthly payments. So the first payment is going to be on 1/31/21. So we don't know what that payment is going to be, but we know that this is a 3-year loan with monthly payments. So there's going to be 36 payments. So I can come up here and I can say calculate. So our monthly payment is going to be $1,992.86. And that's exactly what we see here, and that's exactly what Excel calculates, of $1,993. They're rounding. But the nice thing about a program like this is here is all of the payments. Here's a schedule of how much interest is going to be applied to each payment, how much is going to be principal. And so you can see that this first payment, $600, is going to be interest. And the second payment, $586. Third payment, $572. So with each payment, the amount that is considered to be the interest expense portion is going down. So the very last payment, there's $19.80 that is considered to be the interest expense. But when the interest expense is going down, that means the principal payment is going up. So we start here with $1,392.86 being applied to that principal balance. And so we have an ending principal of $58,607. The next payment, $1,406, is being applied to principal. The next payment, $1,420. Next one is $1,435, all the way down to the last one where $1,973 is being applied to the principal. So the interest is calculated based off of the outstanding principal balance on the loan. So that's why the first payments are always going to have more interest than the last payments, because there's more principal balance that the interest is being calculated on. So I mean, there's a lot of tools out there that will run amortization schedules for you that'll list out, here's every single payment and how to apply. This is the principal portion here, and this is the interest portion. Now, when it comes to booking those entries, we will use that amortization, use our calculations to book exactly how we calculate it. So we know our cash payment is going to be the same, the $1,993, because that's what we calculated here. So on our first payment, interest expense is going to be $600. And so that means our principal payment, the amount that we're going to debit to the note that's on the books, is going to be the $1,393. The second payment, the cash going out, is exactly the same. We're making equal payments. So $1,993 is going out as cash, but the interest portion is going to be $586. And the principal portion of that note is going to be $1,407. Third one, the cash going out is the same, except now we have, again, less interest and more principal. So that's why it's important to understand these principal or these amortization schedules. How much of these payments is going to be a interest portion, and how much is going to be principal portion. And even in our first example, we see exactly that. Here's the 3 payments that we're going to make to get that balance down to 0. And so here's our journal entry. It's exactly the same. Our cash is the same across the board. We have our calculated interest based off of the interest rate times the amount of principal, and the remainder has to be the payment towards the principal balance of the loan. So the last little bit is going to be a mortgage. A mortgage is exactly what we've been talking about, where these amortization schedules for monthly payments can be applied to the mortgage as well, except a mortgage is just a special type of note payable that gives the lender the right to be paid from the cash proceeds of the sale of the borrower's assets identified in the mortgage. So that's why when you buy a home, you have a mortgage, because in the contract, the bank retains the right to say, if you don't make payments, we're going to sell the house, sell the property, and we are going to collect our money from the proceeds of that sale. So that's why there was a big housing or big market crash in 2008, where a lot of people stopped paying on their loans, and so the banks were foreclosing on homes because they were saying, we need our money back, so we're going to sell your home, we're going to collect the money that we're owed, and then you get the rest. So that's what a mortgage is. A mortgage is just an installment note. It's a long-term note payable where the lender reserves the right to sell the property in order to collect what they are owed.